Hello, my name is Elliott. I'm editor of Personal Finance as well as MLP Profits and The Energy Strategist. I want to talk a little bit today about income investing. Obviously an extremely hot topic right now, and you can see why. If you look out there and you look at the yields available on traditional savings products like money market funds or even government bonds, and even look at the yields available on some traditional income sectors like real estate investment trusts. They're all hovering near multi-decade lows, really. And a saver, an income-oriented investor who's looking for regular dividend or income payments from their investment portfolio is really out of luck. There just isn't a whole lot of yield out there. It's very much a low-yield world. However, we're reaching a sort of a demographic area where income investing is likely to become more popular. And these things are quite cyclical. If you look back at the 19th century, for example, read some of the classic investment texts like Reminiscences of a Stock Operator, and you'll see that investors back then really wanted yield even from growth-oriented investments. If you wanted to attract investors to, say, a new automobile company back in the late 19th century, what you used to do is just pay a large dividend, pay an attractive yield. Investors many times expected higher yields from riskier investments than they did from sort of your safe, stable type cash cow companies. In fact, it's really a later 20th century invention, Wall Street sort of invention, that the only companies that are supposed to pay dividends are companies which are sort of slow-growing, staid, sort of, if for lack of a better term, sort of boring businesses that generate a lot of cash. And it's become sort of common wisdom, conventional wisdom, that growth-oriented companies don't pay dividends. And that's absolutely untrue, and it's absolutely the wrong way to look at things. The reality is that as investors, we should expect and we should really look at total return. How much money are we going to make from investment from a combination of dividends as well as capital gains? And I think what's really been missing from the equation in recent years is the idea of dividend growth. It's not just whether you get a 10% yield today, it's whether that dividend can grow over the next 1, 2, 3, 4 years. If you have dividend growth of 3, 4, 5%, that adds up over a period of time and really grows the dollar income you receive from your investment portfolio. So I think the modern income investor is going to focus more on a combination of growing businesses that can generate growing cash flows to pay out higher and higher dividends. Of course, one sector that I think has proven its worth in this regard are the master limited partnerships, a sector that I cover with Roger Conrad in the newsletter we co-edit, MLP Profits. Most MLPs are actually based on the midstream energy business. What they're doing is actually not mining materials or drilling for oil and natural gas, but actually going out and transporting that oil and gas around the country, storing gas in gas storage facilities, and processing gas. Processing gas essentially involves a removal of what are known as natural gas liquids, or NGLs. From raw natural gas. NGLs would include primarily ethane, propane, and butane. The beauty of the midstream energy business is that it's much less cyclical, much less commodity sensitive, and much less economy sensitive than what you traditionally think of when you think of the energy business. The reason is that a pipeline operator doesn't really care whether the price of gas, natural gas, is $10 per million BTUs or $3.50 like it is today. They really only care about the fact that you're pumping gas through their pipeline. They're getting paid based on the volume of gas, and they're also usually getting paid what's known as a capacity reservation fee. For example, if I have a pipeline capable of transporting about 1 billion cubic feet of gas a day, and you're a major producer, you might contract to me and say, I need half that capacity. I need 500 million 500 million cubic feet of gas transport capacity on your pipeline, guaranteed whether I use it or not. In order to reserve that capacity, you would then have to pay me a fixed minimum fee. So pipelines offer, very stable cash flows once they're built and once they have these capacity reservation fees in place. So you might be thinking, where does the growth come from? Well, the growth really comes from what's kind of come to be known as the shale gas revolution. What we've seen is 10 years ago, most energy analysts, the Energy Information Administration, we're all talking about how much gas, natural gas, the U.S. would have to import in the form of liquefied natural gas just to meet growing demand for natural gas as a source of power, as a source of heat, etc. And really, most of the projections showed LNG imports skyrocketing between sort of 2005 and 2020. The reality has been far, far different than that. Over that same period of time, we've actually seen the discovery and rapid development of a large number of shale gas fields around the United States. The first was the Barnett Shale around Fort Worth, Texas. But since then, a large number of new plays have been found and developed, including the Marcellus Shale, which is located in Appalachia in the eastern U.S., the Haynesville Shale, located in East Texas, but mainly in Louisiana. And more recently, I think one of the most exciting shale plays out there, the Eagleford Shale, which is located in southern Texas. Now, the rapid growth and development of these fields, rapid growth in gas production, has served to depress natural gas prices. But the problem is that there's not a whole lot of infrastructure to handle all this new production. We need new storage capacity to store the gas that's produced. We need new pipeline capacity to remove natural gas from these regions. And I think even more important than all of that, we need a lot more processing capacity. The reason I say that is that a lot of the natural gas shale plays in the U.S. are rich in natural gas liquids, as I mentioned before, ethane, propane, butane. And many of them also contain significant quantities of crude oil or crude oil-like products known as condensate. Now, the beauty of NGLs and crude oil, of course, is that their prices are much healthier. So if I'm a quote-unquote natural gas producer in a field like the Eagleford Shale of South Texas, I'm really not just drilling for and selling natural gas. I'm also producing significant quantities of crude oil and natural gas liquids. Now, this is why I can keep drilling even with gas prices as depressed as they are today. The reason is I'm producing this oil and natural gas liquids, boosting my average sales price for my production. The problem, of course, is that processing all those NGLs, removing them from the raw natural gas stream, requires processing plants. And most of those are owned by master limited partnerships. And what we're really seeing is a rapid build-out in infrastructure surrounding these shale plays. So companies like Enterprise Products Partners, one of the largest or the largest and one of the oldest master limited partnerships in the country, symbol EPD. This company is dominating the Eagleford Shale. In fact, they recently announced a deal with EOG Resources, which is one of the largest drillers in that area, to actually handle a lot of their crude oil transport out of that region and also handle a lot of their natural gas liquids processing within the Eagleford Shale. And we're seeing the same type of dynamic happen around a lot of these shale plays around the country. There's a lot more room to go. A lot of these midstream assets are going to have to be built out and improved if we're going to handle all of this new production from these shale plays. On the other side of that coin, we also have a real revolution going on in U.S. manufacturing. I know it sounds kind of crazy and something that most people haven't talked about a lot since the 1970s. But the real growth in production we're seeing from natural gas, as well as these natural gas liquids, is really reducing costs for manufacturing companies in the United States. The cost of energy is actually a lot cheaper than it is in most places around the world. And one of the most important industries to watch is plastics. Plastics, the base chemical for most plastics is something called ethylene. Ethylene can be made from either naphtha, which is derived from crude oil, or ethane or propane, which again are natural gas liquids. With oil prices well above $70 a barrel, natural gas prices down under $4 per million BTUs, it's obvious that most of these chemicals processors are switching from naphtha to ethane and propane. The availability of natural gas liquids in the U.S. is better than anywhere else in the world, including parts of the Middle East, making it actually very, very cheap for the U.S. to produce plastics. The U.S. is not only producing plastics, but also exporting plastics and exporting the natural gas liquids to Europe and other parts of the world which are short of natural gas liquids capacity and supply. So bottom line, I think that income growth is something that all investors have to spend a lot more attention to. Even if you consider yourself to be a growth investor, don't forget dividends, and don't forget that ultimately what you want to see is income-oriented investments that pay you rising dividend streams. If you're an income investor, don't just look at the percentage dividend yield. I can point to any number of companies that were yielding 10, 15% during the financial crisis, which are no longer listed because they went bankrupt. But if you can look for and identify companies with sustainable business models and dividend growth, you can actually do a lot better than that. Some of my favorites, such as Enterprise Products Partners, which I mentioned, actually carried on increasing dividends straight through the financial crisis. So look for dividend growth. One of my favorite sectors for that, master limited partnerships, and in particular, master limited partnerships leveraged to the shale gas revolution. Thank you very much.